All right, thank you everyone for joining us for this Keys to Home Buying workshop. My name is Jessie Garrison with GreenPath Financial Wellness. GreenPath is a nonprofit organization. We've been around since 1961, and I've been in the financial industry since 2005 and at GreenPath since 2017. And we absolutely love speaking about home buying and financial education. So we're glad to have you here today. Excuse me. Today we were walking through the steps home buyers take from preparing to purchase a home to working with a realtor and a lender, to searching for some homes and making an offer. We'll also cover what happens after your offer is accepted and on closing day, before wrapping up with some keys to a successful homeownership long-term. If you have any questions along the way, please go ahead and send those in chat. We will have a few minutes at the end to answer any questions. So making a decision to purchase a home is an exciting, however, potentially overwhelming and stressful time. Houses are typically the largest purchase many people make, so you want to be sure you are prepared as you enter the process. The first thing that you'll want to work on and take a look at is gathering the documents that you will need when working with a mortgage lender. Exact documentation needed may vary. However, it typically includes 1 to 2 years of W-2s and tax returns. And you'll want at least the most recent 30 days of consecutive pay stubs or other sufficient proof of income. And you want at least 2 consecutive most recent months of bank statements or credit union statements, wherever you do your banking. As well, you're going to want to have statements for any investments or any other assets, accounts, savings, things like that that you might have. And then if a relative is gifting you any funds towards your home purchase costs or closing costs, they may need to write you a letter that guaranteeing that this is a gift and not a loan from the individual to the home buyer. You may also be asked to share a proof of your rental payment history, especially if applying for an FHA type of mortgage. Once you have gathered all of your documents, you want to use these documents to determine and create your budget. You'll want to start by reviewing your income and determine your net income, which is the amount of money that you actually take home after taxes and deductions are subtracted. Next, you want to list out all of the expenses. You want to use your statements to review spending and determine actual amounts for each expense category that you have. It's helpful to look across multiple months and find an average, as expenses can vary from month to month, of course. Your goal here is to have a solid understanding of where every dollar you earn goes, so that you know how much money you can afford to spend comfortably on a mortgage and other payments related to the new home. Once you have developed this list of expenses and developed a budget of how much you estimate you would like to spend on each expense category, spend a month or two tracking your spending carefully to ensure that you have captured all expenses accurately and confirm that you are comfortable with the budget that you have developed. This will be a key step in determining how much money you can truly afford as you start looking at purchasing a home. It's also recommended to review your credit reports as soon as you start to think about purchasing a home that may be on the future in the horizon. You can review your own credit reports from all 3 credit bureaus, TransUnion, Experian, and Equifax, for free at annualcreditreport.com. So you can see annualcreditreport.com on the screen as well. Reviewing all 3 of these reports is important because some creditors may not report to all 3 credit bureaus, so information can and will vary. Reviewing all 3 reports will help you to have a clear picture of everything reporting under your name. If you find any errors or inaccurate information, you may file a dispute with the credit bureau directly. This process can take a bit of time, so the sooner that you can start the dispute process, the better, to avoid holding up any mortgage application process. If you have negative items on your credit report that are legitimate, those that are typically unable to be disputed, if it's accurate information, however, just bad information, you did have a late payment, you can, however, add a note to your credit explaining the negative items, especially if there was an emergency or situation out of your control that led to accounts falling past due. This notation will not impact your credit score, nor does it remove the negative item. However, it can give some context to the mortgage lender reviewing your credit to take that into consideration. Now, once you have laid the groundwork and you're ready to start taking some concrete steps towards finding and buying a home, you'll want to find a realtor and a lender to work with. These individuals will be guiding you through the large purchase, so you want to be sure that you trust them and feel comfortable working closely together with the real estate agent. When looking for a realtor, it's a great idea to start by asking friends and family in your area who have had good experience with the realtor that they used. Just as important, be sure to find out if there was anyone you know who has had a negative experience with a local realtor. You can also search online for recommendations of local realtors in your area. Be sure to read reviews carefully and do a thorough research before making a choice. Consider interviewing a few realtors in person to decide on who is the best fit for you, especially without personal recommendations from friends or family. As you research and interview potential realtors, it's important to make sure that they have proper credentials. Of course, reputation is important, and you will want to be sure that they have the proper expertise to guide you through this process confidently. What experience do they have in real estate in the market that you're planning to purchase in? Are they someone that has bought and sold houses in that area? So in addition to finding a realtor to guide you through the process, you'll need to find a lender to help you finance the purchase. Start your search by meeting with the mortgage department at your own credit union or your bank, where you're doing your banking right now. This is a lender that you already have a relationship with and you can trust, so it's a great place to start. If you want to search around and compare rates across a few different lenders, get all of your ducks in a row and submit your applications together within a short period of time to limit the credit impact, the credit score impact. If applications are spread out over several months, you may start to see your credit score drop due to multiple hard inquiries over a longer period of time. If the inquiries are closer together, ideally with 1 or 2 weeks, it will be obvious that you are rate shopping and you will not have the same negative impact on your credit score. Before starting your home search process by looking at specific homes, you may consider applying for a pre-approval. This will help you to know for sure how much financing you will be able to get, so you know what the price range to search within. It's imperative to get pre-approved before looking at homes to prevent the deep disappointment of falling in love with a home that is outside the price range that you'll be able to get a mortgage for. It can be exciting to start looking at specific homes. I don't recommend that you skip this step. You want to know exactly how much you can afford. This pre-approval means that the lender is tentatively willing to finance a mortgage up to a certain dollar amount. This is not a guarantee that you will be able to get this loan, but it lets buyers know that you've started the process and have a reason to believe that you should be able to obtain sufficient financing when you make an offer. This can be a leg up if you place an offer on a home that has multiple offers. A pre-approval gives the seller confidence that you are likely going to be able to move forward to close on the purchase of a home. Final approval will come after you have found a specific home and move forward with requesting a mortgage for it. When issuing a pre-approval, it is imperative that you know what you can comfortably afford in your budget. A lender typically won't look at all of your living expenses, so they may pre-approve you for a loan that is more than you can comfortably afford within your monthly budget. So knowing what you are comfortable spending overall on the home, as well as what you're comfortable spending on a monthly mortgage payment, and share this with your lender up front. Just because you are pre-approved for a certain amount does not mean you can comfortably afford it in the future. You will also need to be prepared with sufficient savings for a down payment, closing costs, and other upfront expenses that can vary depending on how much you are purchasing the home for. This will also be important to consider when determining for sure what price range you can afford to search for homes within that price range. And finally, it's important to know that your property taxes and homeowner insurance costs will be. These are typically included in your mortgage payment. However, they are likely to change over time. When figuring out what monthly amount you are comfortable spending in your budget, be sure there is wiggle room for that payment to increase without causing strain. This can happen as soon as the first year after buying your home. Once you have chosen a realtor to work with and have identified the price range you are comfortable with and received a pre-approval from at least one lender, now it's the time for fun, searching for your home. It's unlikely you will find your perfect dream home that checks every box on your wish list. So it's important to think about what are non-negotiables and what are nice to have features. However, they're things that you're willing to budge on. Choosing a location is one of the first decisions you will need to make as you start your search. What neighborhood would you like to purchase in? What's the school district? Is it close to work, close to freeways? Do you have or plan to have a family? Again, the school district might be important, but maybe it's not important for a few more years. So how close do you want to be to the school that your kids may attend in the future? Again, how far away from work are you willing to live? Is there public transportation options? Are those able to get you to work easily? Is this important to you? You'll also want to consider what the property taxes are on average. Taxes can vary significantly in some areas, and if the property taxes increase or are higher than expected to begin with, it could break the budget, as it may lead to a mortgage payment that's out of the range that you're comfortable spending, even if the purchase price is right. It's also helpful to think about what other places you frequent and determine how close to or how far away from them you would like to live. Consider what other things that you would like to live near: parks, libraries, grocery stores, public transportation, other friends or family that live in the area, maybe anything else that might be important to you. And finally, when choosing a location for your new home, it can be helpful to look into things like noise and traffic levels, as well as safety considerations. Beyond location, you will also want to identify what are the needs and what are wants. Start by considering things like a number of bedrooms and bathrooms. What's that ideal number? What is the maximum that you could go up to? What is the absolute minimum that you're going to need for the number of bedrooms and bathrooms to make the home work for you? You may also want to think about square footage needs. Again, is the current family going to grow? Do you need more space in the future? And then you also want to consider what style of home that you're interested in purchasing. Is this going to be a single family home, a duplex, a townhouse, a condo, 1 or 2 stories? You may also want to consider the aesthetic and the floor plan styles that you like as well. I can share with you an example from my home search. I've owned my own home now for about 10 years, but I was absolutely adamant at the beginning. I wanted a condo, not a home, and I wanted a detached condo, not an attached condo. However, after falling in love with the condo that I have right now, I ended up moving into an attached condo. So again, all of these things are important to consider. I think it's important, almost as important, if not more important, to consider the things that you absolutely do not want. And even though I did not want an attached condo, I'm in an attached condo now, and I absolutely love it. You may also want to consider, do you love the outdoors? Do you dream of planting a huge garden? Or do you have room for kids or pets to run around freely? Outdoor space is another thing to consider. What is that need? What is the want? The kitchen. Oh, the heart of the home is in the kitchen. So it's another thing that you may want to consider for the needs and the wants, what's related to those type of things in the kitchen. Take some time to determine what you need, what you want, and what you might be willing to compromise later or potentially modify later. What other features of a home are needs for you and your family? Identify these non-negotiables and share them with your realtor so they can help you to search for homes that meet those needs. Now, once you find a home that meets your needs and all of your wants, and hopefully it's now time to make an offer. So what does that look like? When determining what to offer the seller, you will want to consider what your purchase price will be and what you would like to ask the seller to agree to. So they might have a listing price. You might offer to buy it for less or more than that listed price. Your offer can also include any contingencies you may want to include, which can range from agreeing that the buyer can bow out without consequences if the appraisal comes in low or the inspection indicates drastic repairs, or it could be agreeing that the buyer has time to sell their current home before closing on the new purchase. The buyer may also want to request certain concessions from the seller in their offer, such as a seller's assist that would cover some of the buyer's closing costs and reduce the amount of cash a buyer would need to close. There are limits to a percentage of costs a seller is allowed to cover, so be sure to talk this through in detail with your realtor. Your offer can also include when you would like to close on the home and move into the property. You can also provide the buyer with a deadline to respond to your offer, as well as you can indicate how much money you are willing to put down as an earnest money deposit, or you may hear that as an EMD. This indicates to the seller that you are a serious buyer and plan to move forward with the purchase, giving them a reason to confidently remove their home from the market. Any earnest money deposit that you put down goes towards your closing costs, or down payment at the time of the purchase during your closing. So this actually is just cash up front to reduce the amount of cash that you need at that final closing table. So now you've submitted your offer on a home that you're really excited about. Hopefully it's accepted by the seller. There may be some negotiation, which you will work on with your realtor. Again, your realtor is going to help you with all of these steps. Once your offer is accepted, there are some important steps to take to close the deal. The first step is to actually fully apply for a mortgage with the lender of your choice that pre-approved you. There are a variety of mortgage types available, and your lender can help you determine which might be right for you. The most common mortgage type is what is known as a conventional mortgage. These tend to have stricter lending requirements and are typically an option that makes most sense for someone with a high credit score. An FHA mortgage is designed to help make homeownership possible for more people, including those with slightly lower credit scores or lower incomes. These mortgages are backed by the Federal Housing Agency, FHA, and it typically comes with a lower minimum down payment, and potentially lower credit score requirements. FHA loans can be a great option for many first-time home buyers. If you are a veteran or active duty service member, a VA mortgage may be a great option for you. National Guard and Reserve members may also be eligible. VA loans allow you to purchase a home with no money down, competitive interest rates, and oftentimes limited closing costs. Veterans or service members must obtain a certificate of eligibility through the VA, and your lender may also be able to help you obtain this. Another government-backed mortgage is called the USDA loan, which is specifically for properties that fall in defined rural areas. Buyers must meet certain income requirements. However, they are eligible for 100% financing, meaning no down payment. The home must be located in a USDA eligible rural area to qualify for this mortgage type. When applying for a mortgage, you may also be offered a fixed rate option or an adjustable rate option. You might also see an adjustable rate option called an ARM, A-R-M. A fixed rate mortgage means the interest rate will remain the same for the life of the loan, while an adjustable rate mortgage, ARM, may change over time. Typically, adjustable rate mortgages offer one rate for a defined period of time, after which the rate may change to match market rates. This could mean that your rate increases or decreases. When considering whether a fixed rate or adjustable rate mortgage makes sense for you, it can be helpful to think about how much time you plan to stay in the home. Talk this through with your lender. If you plan to stay 5 years or less, it may make sense to weigh your options more carefully. One thing that can be helpful to understand is the difference between the APR, annual percentage rate, and the interest rate. The interest rate is the percentage you are required to pay to borrow the money for a period of time. And the APR includes the interest rate, but also adds in other fees you will pay the lender in order to better represent the total annual cost to borrow this money. Comparing the annual percentage rate, the APR, and choosing a lender can give you a better idea of the more affordable option compared to looking at just the interest rates. While it is possible to get a mortgage with less than 20% down, you will typically be required to pay for the additional insurance that protects the lender because they are taking on more risk by lending you more of the home value. If something were to happen and you were to default on the mortgage, the lender is at a higher risk of loss. This insurance is called either PMI for conventional loans or MIP for FHA loans. PMI, which is short for private mortgage insurance, is typically required if you obtain a conventional loan with a down payment lower than 20%. Once you reach 20% equity in your home, you can reach out to the lender and request your PMI be canceled. If you don't proactively request the cancellation, it should be automatically removed once your loan's principal balance reaches 78% of the home's original value. Mortgage insurance premium, known as MIP, is required for all FHA loans, regardless of how much money you put down. A few key differences with MIP compared to PMI is that FHA loans require not just the annual MIP, but also an upfront payment as well. This upfront MIP can be financed as part of your loan, and both the MIP and the PMI are typically paid as a part of your monthly mortgage payment. Another key difference is that MIP will typically be required for the life of the loan, unless your down payment was 10% or more. If you made this size of a down payment, MIP will cancel after 11 years. If your down payment was less than 10%, your MIP will not cancel until the loan is paid off, or if you were to refinance to a conventional loan after reaching at least 20% equity. So I know this is a lot. Your realtor and your lender will help you understand the difference between the MIP and the PMI. Typically, your monthly mortgage payment includes 4 main components: principal and interest, taxes, and insurance. We just talked about one form of insurance. However, you will also need homeowner's insurance homeowner's insurance for any mortgage, and you will have property taxes to pay as well. While property taxes and homeowner's insurance are typically paid out once per year, you can pay towards that annual amount on a monthly basis as part of your regular monthly mortgage payment. This goes into what's called an escrow account, which your mortgage company will hold onto and then use to pay your taxes and insurance premium when they come due once per year. Again, once a year, your lender will review the escrow account to determine if a sufficient amount is collected to ensure that the taxes and insurance can be paid on time. They will send you a notification letting you know that your mortgage payment will increase or potentially decrease to maintain future escrow payments. It is important to know that this can happen as soon as the first year, so you can and should be prepared for this possibility of a change in the payment. When determining whether or not you can, the lender can extend the loan to you, underwriters look at a variety of factors. The first of which is capacity. Do you have the ability to repay this loan if they extend it to you? Underwriters will review your income and employment history, how much money you have in savings, your current monthly debt payments, and other financial obligations. They will review how the requested mortgage payment fits in with this to ensure that you are likely capable of financially managing all of the obligations plus the new one. The second thing the underwriters will look at closely is capital. Do you have cash or assets available that could turn to if needed to meet your obligation to repay this loan? This also shows a potential lender you have excess funds available on a monthly basis to save or invest, further proving that you can afford to take on a mortgage payment. The next thing underwriters will consider is your credit history and your credit score. This will indicate to the lender how you have managed accounts previously, as well as how you are currently managing credit accounts, to indicate how risky it is for them to extend more credit to you. The higher your credit score, typically the more options you will have available to you, and the better the interest rates or the APRs you will get. While it is possible to obtain a mortgage with a lower credit score, it may be in your best interest to get your score as high as you can before applying for a mortgage. And finally, underwriters are interested in the collateral you are pledging on this loan. For most mortgages, this will be the home itself. The underwriters will want to ensure the home is worth enough to cover their losses if you were to fall behind on your mortgage, so far behind on your mortgage that they need to foreclose. This is typically determined through a home appraisal. Once you have submitted a full mortgage application, you will receive a loan estimate. The lender is required to provide this to you within 3 business days after receiving your completed application. This loan estimate is not a guarantee that your loan application is approved or denied. However, it is designed to give you all of the details that you need to know if you decide to proceed with seeking this loan. Also including the estimated interest rate, the estimated monthly payment you can expect, including estimates for the portion that will go to taxes and insurance, and the estimated amount of closing costs and the estimated total amount of cash that you'll need in order to close, which you'll typically need to be paid by wire transfer or cashier's check on closing day. The loan estimate will also provide you with any other unique details or expectations related to the loan. This is a document you will want to review thoroughly and make sure you understand before agreeing to move forward. After your loan application is submitted, the next step will be a home inspection. Home inspections are not typically required. However, they are highly recommended. A home inspection is for your protection as the buyer. It is to help you enter the purchase with a clear idea of flaws or warning signs in the home. You as the buyer will choose a home inspector, so be sure to shop around for one that you can trust. FHA loans require a specific inspection to ensure the property meets certain standards. It is still recommended you hire your own inspector to take a look at the property thoroughly as well. When you made your offer, you may have included contingencies related to home inspection findings. If an inspection shows a major issue with a system or a large repair is needed, You may be able to negotiate with the seller to ask them to fix it, to reduce the purchase price if you'd prefer to fix it yourself, or you may have the right to cancel the agreement to purchase the home if you are dissatisfied with the inspection or cannot agree with the seller on resolving concerns. This is something to talk about with your realtor in detail when submitting an offer to make sure you are fully covered as a buyer if the inspection reveals major concerns. A home appraisal is different from a home inspection in that the inspection is designed to give the buyer a clear picture of the condition the home is in, and the appraisal is designed to let the lender know how much money the property is worth. The mortgage lender will hire an appraiser and work with you to schedule. Unlike the home inspection, you as the buyer do not get to pick the appraiser. The appraisal will confirm how much money the mortgage lender can extend a loan to you for based on the value of the property. If the appraisal comes in lower than the amount you are asking to borrow, you will either need to come up with more money to bridge the gap or potentially see if the seller is willing to negotiate a lower price. Once you have gotten through all of the paperwork, phone calls, inspection, appraisal, gathered all the money you need, now it's time for the exciting part, the actual closing day. Leading up to closing day, you will receive some documents ahead of time to review that can help speed up the process a bit at the closing table. You will want to review these documents closely and reach out to your realtor and your lender immediately if something seems incorrect. Legally, you are required to be sent your closing disclosures 3 business days before you are scheduled to close. So you have sufficient time to read and review and understand all of these documents. You will also want to confirm with your realtor the exact location to meet for closing and plan to arrive early. You can also request a final walkthrough of the home, which can be used to confirm the seller made any requested repairs, make sure the home is still in good, if not better condition as it was before, and it verifies that all agreed upon appliances remain in the home. Prior to closing day and receiving your keys, you will need to reach out to the utility companies to schedule all utilities to transfer to your name by the day you plan to take possession of the home. Even if your move-in date will be delayed, you will still want to move utilities over as of the day the property is officially yours. You will also want to contact and connect with your realtor and your lender about what you need to be sure to bring with you to the closing table. This typically includes a valid photo identification for all borrowers, and usually a certified check or a money order or a wire transfer to pay the final closing costs and the remaining down payment. After you've signed more paperwork than you could have imagined, handed over a large sum of money, and finally get your keys, now we can say congratulations, you're officially a homeowner. The journey doesn't stop here. It doesn't stop with walking in the front door for the first time. Before we wrap up our time together, we do want to share some keys to successful home ownership beyond closing day. The first tip is to prioritize rebuilding your savings account as soon as possible. If most of your savings went down to use for the down payment, the closing costs, and moving expenses, it can be tempted into jumping into renovation projects and home improvements. However, pausing first to get money tucked away for emergencies is highly recommended. As a homeowner, when an appliance breaks, you are now responsible to fix or replace it versus calling a landlord to do so. It's also recommended to map out an annual home maintenance plan. This is something that you can research online for, recommendations for what to include, when to do it, and how often to do it. So figure out a method to stay organized and keep track of the maintenance of when it's completed and when it's due. Again, as a homeowner, there are more possibilities for emergency expenses than a renter. It's recommended to keep an emergency fund separate from other savings for things like a renovation or a vacation. This ensures that you have money tucked away for unexpected major expenses that won't be touched until needed for home maintenance. As we discussed earlier, your mortgage payment may increase as your homeowner's insurance and taxes change. As you revisit your budget from time to time, keep this in mind to be prepared for a potential increase in your monthly payment. Now, this will be typically once per year, so it's not like you're going to see just a random change in your payment next month. As you plan what repairs and improvements you want to make to your new home, prioritize any major concerns the home inspector found. These may not always be the most fun or cosmetically pleasing improvements. However, they can be the most important to take care of first. You may also need to build up savings to take care of larger repairs, and having a plan for this can be helpful as well. And the final key to successful homeownership is to always prioritize your mortgage. A foreclosure can begin as soon as 3 months after falling past due on your mortgage. So making this payment your top financial priority every month is very strongly recommended. If you are ever concerned about making your mortgage payment, reach out to the mortgage company as soon as possible to discuss your options. There may be both short-term and long-term hardship options available, and the sooner that you explore them, the better. You can also reach out to a HUD certified housing counselor to talk with someone about your housing situation. GreenPath Financial Wellness has housing counselors on staff who can help you understand your options, come up with a plan, and can even help you reach out to the mortgage company to take action. Again, we also recommend that you utilize resources. GreenPath can also provide a couple of worksheets and guides that may be helpful to get started. We do have a guide, Rent versus Buy, or the GreenPath guide for the pre-approval checklist. And we'll send both of these to Fort Sill to share with everyone after today's webinar. Also, I'll share a couple of links. We talked about making sure that you understand your credit score, your credit report, and we talked about having a clear and detailed budget. So we do have a couple of resources online that you may like to see for those two options. I'm going to put those links in chat. Again, if you would like to take a closer look at your specific situation, you are welcome and encouraged to call GreenPath Financial Wellness for a free, confidential financial assessment. GreenPath certified counselors can review a soft pull of your credit report with you and talk about steps to get ready to buy your home. We can also help you take a look at your budget and help you to collaborate and develop an action plan to work towards any of your financial goals. And GreenPath can also talk about other financial concerns or goals that you have related to student loans or unsecured debt, credit report, your credit score. Now, I didn't see any other questions come in. If you do have any questions, please send those in via chat. We're happy to help answer any questions. I know it was a lot of information. There's a lot of little fine details here. I think we do have officially 5 more minutes, but I'm happy to stay if you do have questions. And if you think of something later today, tomorrow, next week, if you think of something, please reach out to us. You can speak with a certified financial wellness expert for free, and we can go over your specific details, your specific questions, and make sure that we help get you on the right financial path forward. Again, I do appreciate everyone being here this morning. We appreciate your patience with some of the technological difficulties here at the beginning. Again, if you have any questions, please reach out to us either today or another time here. Let us know how we can help you.